Every bit you save is more money for yourself.
Once we start to see the fixed interest rates starting to drop below the variable rate, it's generally an indication that variable rates are on the way down.
A lot of doctors are not just employees. Some 5 years out, they'll start becoming sole traders or they'll have companies. How are income assessed that way when you don't get a pay slip? Because that's going to affect a lot of people in the medical profession.
Get your profit and loss drawn up every quarter, be consistent so you have documented evidence of what you're earning and your expenses. And I think a lot of people don't realise.
Hi there, this is Dr. B, and welcome to another installment of the Investing for Doctors podcast. Today we have Alyssa and Elle back again from Two Birds and One Loan. Hi everyone.
Hi B, thanks
Hi, B.
for having us.
Yeah, so we're going to dive straight into it because in a previous episode we introduced both of you, and we're going to do a bit of deep dive into the mortgage world today. Previously, we touched on concepts like LVR, LMI, and owner-occupied and that sort of thing, and how it affects rates. So today, we're going to dive a bit deeper into some of these things. We previously talked about the different kinds of products out there, and it sort of made me think about banking products slightly differently because, there's the fixed rate, there's the redraw facility, and there's also the offset facilities. In essence, there's actually really three products, and how much variable is attached with that product is based on your property, how much LVR and everything is in there, and sort of your rates get affected by it. So let's go into each of these things individually. First of all, let's go with the most common one. So it's a loan with an offset account. So tell me a bit more about that and how all of that works.
So an offset account is typically a separate transaction account.
Mm-hmm.
There are some exceptions to this, which we can discuss in more detail, but essentially what you do is you sit your cash in this separate offset account. And if you have a loan of $100,000 and you have $20,000 in your offset account, each day interest is chargeable on what is your loan balance less what you have sitting in your offset account. So interest, it's charged monthly, but it's calculated daily.
Yeah.
So essentially whatever is sitting in there, you're not paying interest on.
Mm-hmm.
So even if, for 2 days of the month, you had the whole loan 100% offset, there's no interest charged for those 2 days. So you do pay a fee typically for an offset account. And there are some lenders who offer multiple offset accounts. And we often get asked for by customers as one of their non-negotiable requirements is that they will want to have access to multiple offset accounts. So we have a whole range of lenders that have that option. But some lenders, some of the major players actually are still limited to only having one offset account per loan split.
When you have an offset account, it has to be a bank that actually has that, isn't it? Because they're the only ones that can technically give you a transaction or a real bank account.
Yeah, it is a separate transactional banking account. And there are some non-bank lenders that do offer an offset account, which I suppose technically is more like a sub-account of the loan. It's not an independent account, but it is an account that they can access with the card. So technically, no, it's not a transactional bank account. And if you shut that loan down,
you're going to lose that account.
You would lose that account. But with most lenders and the bank lenders, that account will remain. So if you refinance your loan, that will just tick over. Instead of an offset account, it becomes like CBA calls it a smart access or something like that. It just flicks back to that normal transactional bank account. So yeah, typically it is an account that will freestand whether or not you have a loan account linked to it as offset.
Yeah. And I guess the difference between that, that sub account and an actual bank account is that whatever money you have on there is guaranteed by the government, isn't it? Because the banks actually pay insurance on that and you're insured for up to $250,000
yes.
In those situations.
Yeah. The Australian deposit taking institutions. And this was a big conversation post GFC because there were so many funds lost through that process. But the banks would all sort of advertise that they were an ADI and that money sitting in the offset accounts was guaranteed by the government.
Yeah. So so for the viewers that have only heard of this the first time, an ADI is authorized deposit taking institution, and that they are typically what we would call in Australia banks. If the lender is not an ADI, it's really not a bank, and that's how they classify under the non-bank lenders. And so what is the real difference between a bank lender and a non-bank lender?
They're different in terms of what they offer and who governs them and things like that. So, banks are quite heavily regulated and not to the same extent as some of the non-bank lenders. So the non-bank lenders, as I mentioned in the last episode, like one particular lender, or a couple of them actually, are not subject to this ASIC buffer that the banks are subject to.
As a 3% buffer.
Yeah, so the 3% buffer that's applied to all the serviceability calculations. So we have some lenders that only have to apply 2%, but they're not subject to all the same regulations.
So I guess as a bank, their cost of doing business is technically higher, but because they're also much bigger and their cost of capital is a bit less because they can take in savings. Whereas a non-bank lender can't.
Yes,
you can't deposit money at a non-bank lender because they're not.
That's right. And quite often the non-bank lenders will have much more flexible policies for that reason, because they are governed by different bodies and have different rules and regulations. So quite often when it doesn't fit in what we call the conforming space, which is your bank lenders, we will look to a non-conforming lender. And, that can be anything from sort of, different types of securities or different types of income verification, which we can probably get onto later. So we can look at sort of low doc means or no doc means of income verification. It just opens up a lot of different pathways.
And this is not the typical stuff that you will walk into a branch, because most of them
That's
don't
right.
have branches, and
No.
you have to go through a third party like yourselves.
That's right. Yeah. And quite often a lot of these non-bank lenders will be open to brokers only.
Yes.
So which is another advantage of coming to use a broker, is you will have access to a lot of lenders that you may not have access to just as a normal consumer off the street.
Okay. That also brings us to the next sort of type of account, which is a bank account with a redraw facility. And I think that's something a lot of the non-bank lenders use.
They do.
When you actually deposit money into the actual loan account. But correct me if I'm wrong, it's like whatever excess you put in there is almost seen functionally as a transaction account or offset account that you can take money in and out of, right?
Yeah, that's right. I mean, redraw does work very differently to offset, but it has the same net benefit. So you're still offsetting all of your interest, but instead of sitting in a separate transaction account, it's actually sitting in the loan account. And all of these non-bank lenders have different ways of operating. Some of them have, key cards that are linked to these redraw accounts. Some of them you need to link your own bank account so you can transfer back out of them and then use the funds accordingly.
Yeah, but the rules of taking that money out is up to the non-bank lender, I suppose. Whereas in a normal bank account, the bank can't say, hey, you can't take all that money out.
Yeah, I mean, not that we see that, but I suppose they would potentially reserve the right. And, if they find out that you're refinancing, they will freeze all of those accounts. So,
would they? Yeah.
So whereas typically that wouldn't happen with an offset structure. But if you were to refinance from a non-bank lender and you've got money in this sort of sub-redraw account, once they provide their payout figure to the other bank, they can freeze everything. And that's
if they're using that as a transaction account.
If that's their everyday spending.
That's actually caused us some problems in the past where, we're 3 days out from a refi and they can't access any of their funds that are sitting in their redraw.
Yeah.
But we're always quite clear with customers that do have redraw. If you do need this money, you need to transfer it out.
Or at least some of it out before we advise of the refinance.
Well, I mean, the way I look at it is that when you have a true offset account, that is your money.
That's right.
That you can do whatever with. And
for you.
When it's in a redraw account, that money technically is
you've paid it off
with
the
bank. You already paid it off. The bank can say, the non-bank lender or whatever, whoever's providing that loan can say, well, no, that is part of the loan, and we're not going to give you
Not
access
going
to
to give
it.
it to you.
Yeah.
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 Which doesn't happen. I've not seen
Not
that.
in Australia, but I think overseas that has definitely happened during the GFC.
Okay.
None of that has actually happened in Australia, but we've definitely heard about it happening overseas.
Yeah.
So in a way, it's a theoretical risk that we as the lucky country have not yet had to suffer through any of that. So, but yeah, it's just an idea that you know what you get into when you utilize a product. Yeah. I guess then we move to the third one, which is a fixed loan. How is a fixed loan structured?
So a fixed loan is the banks will release fixed interest rates, and they vary from, 1 to 5 years. And there's a few lenders that do go, outside of 5 years, but in general terms, you can fix for anywhere between 1 to 5 years. And they would be you can fix for P&I and interest only. And then a lot of people use fixed for budgeting. I mean, look, when interest rates were really, really low, we were finding that we were fixing a lot of people because interest rates were, around the 2% mark, and that was a smart move to make. But at the moment where the variable interest rates are sort of hovering around the 6% mark, we're seeing a few fixed rates for, over a 2-year period, around the 5.7 mark. And we're getting a lot of questions. Should I fix? What should I do? Should I fix my rate for the next 2 years? And, and in all honesty, it really comes down to your risk profile and what you are most comfortable doing. But I think from a personal level, I would be more inclined to ride the variable wave.
Yes.
Because once we start to see the fixed interest rates starting to decline or drop below the variable rate, it's generally an indication that variable rates are on the way down.
Yeah.
So
we can't give advice on it, and we don't. All we can do is say, this is your option on a variable. These are the risks. And fixed rates, there are limitations. You can't pay them off as quickly as a variable. You're limited, and it varies between lenders, but typically $10,000 per year is the maximum you can pay off. You can't offset a fixed rate with most lenders.
Yes.
There's lots of other factors at play. Yeah, fixing at the top end of the market, I did it once in 2008 or something. I fixed at 9% and then they all started coming down. Fixing it's a gamble almost because you never know what the variable rate will do.
Usually will know a bit more than you do.
Yeah.
So
and that's right. And then if you fix and interest rates drop, and you'll say fixed at 6% and interest rates, drop to 5%. If you want to exit that fixed rate, you're then going to be subject to a break fee, which will be calculated based on how long is left on your fixed term and what the current interest rates are now. So your break fee will vary from week to week if interest rates go up. So if you fix at, say, 6%, but then interest rates go up to 7%, in most instances, you get a get out of jail free card. So if you do want to break, but, you wouldn't. But if you need to, you can for not a cost. So I think it's just important to understand the ramifications on, a rate rise or a rate drop. On your fixed rate.
Yeah, and in the current climate, we're pretty much at the top of the market. Right now.
That's what they say.
That's what they say.
Yeah, over the last couple of years, the most time we've really fixed anyone for is 12 months.
Yeah.
And that worked out quite well for them. But fixing at sort of 5.5 for 2 or 3 years right now, it's a long time. Lots can happen in 3 years.
Because how far we've come in 3 years already. Like if you look at where we were 3 years ago and look at us now, like it's chalk and cheese. The market has completely
such a
changed.
long time. So it's there for a purpose. If you're someone who likes to know that you're not going to be subject to any differences over the next year or two, they're the people that will fix. But not many people are choosing to fix right now.
Yeah. And just comparing Australian market and the overseas market is very interesting because in some places overseas, you can get a 30-year fixed loan. And a lot of people during the COVID period, they got a very good 30-year loan. And reflecting back on my understanding of the treasury bonds market in, Australia, we typically, our treasury bonds, even though they can go for 30 years, it's not as big a market as say in the US where 30-year bonds are quite common. Because that's what the sovereign states will purchase. And so when you have a product from the government and you have a bank lending product that can match that, it becomes easier to write 30-year loans. Because where I've grown up and come from, fixed rates are the norm. Whereas in Australia, it's not. So
in the UK too, I think almost all loans
in a
are
couple of
fixed.
other countries, and and this is for our listeners who might have migrated to Australia, because a lot of the medical workforce are migrants, including myself. This is one of the reasons why, because the Australian capital market is very different from the some of the other overseas market.
That's right.
Yeah, that's a little tidbit. The next part we want to really delve deep into is assessing income, because a lot of doctors are not just employees. Most of us start off as employees, but some, as soon as 5 years out, they'll start becoming sole traders, or they'll have companies, or they work in trusts. How are income assessed that way when you don't get a pay slip? Because that's going to affect a lot of people. I mean, it applies to a lot of people in the medical profession.
Yeah. So we do see this, and the income can see a very steep growth in the medical space once the study's completed, and often a doctor might start working via an ABN, and they suddenly might find themselves earning $50,000 a month through an ABN, and there's no history of earning that. So in the normal lending space, you would have to be earning that for at least 18 months to 2 years for the banks to utilise that average income. But there are some specialist health teams within a lot of the banks these days. So ANZ Health, Westpac, CBA have just started a health team, and they do all sorts of weird and wonderful policy exceptions for medical professionals who are in that period, who might have just started on an ABN and they've got at least 3 months on the ABN. And it's advisable, if you're in this situation, to work with an accountant who can really document this income for you if you're wanting to get some lending in place quite quickly once you're on these incomes. So get your profit and loss drawn up every quarter, do your BAS, be consistent so you have documented evidence of what you're earning and your expenses. And we've done loans for doctors, 95% loans, investment purpose, with only 3 months on the ABN, where the bank has annualized.
Yeah.
Annualized 3 months only. So they look at other things. They do look at the earnings over the last 12 months, and they like to know what the expenses will be. But that policy is just wildly outside of what they will do for any other profession. It's very, very niche. And I think a lot of people don't realise. They think once they're earning good income, they have to wait before they can start investing.
Yeah.
But they don't.
Yeah, and often we hear people saying, I went to my bank and they said I needed 2 years of income tax statements. And I guess that's the vanilla approach to a business. Whereas for doctors, that's, if you can prove a BAS, usually your earning will go up and not go down when you start off in private practice.
Yes.
So is that one of the reasons you...
Yes, because I think it's just known when you hit that point in your career that your income does go from this to this, and the earning potential is just phenomenal.
It's just a tried and proven strategy, and they know that doctors are a low risk clients, and they do know from all the data that they hold that more often than not the doctors don't have these loans for 30 years. They pay them off quite quickly. They build up their offsets very, very quickly. Like, they've got all the data to support these cases for policy exceptions.
Yeah, and I guess that's how we are assessed as sort of low risk clients, and so that's why they're willing to do a bit more to get the business, because otherwise someone else would take that. Yeah. So in a situation where it's a company versus a sole trader, do they view that with much difference at all, or do they view that as quite similar, as long as...
I mean, it depends if we're talking medico or not medico, but in terms of just if we're looking at a normal company, let's say not a company borrower, but a borrower who runs a company. Yes.
Let's just go the non-medical. In general, a company, say I run a bakery and I generate X amount of profit in the bakery.
Okay, so in that scenario, yes, there's lots of ways we can assess that person. And I think the benefit in that case of having a company structure is if there's company liabilities. There's, equipment finance and car loans and things like that. And if the director of that company pays themselves a wage of $100,000, and that is quite common when someone has a company, they will pay themselves a wage. So a lot of lenders will look at the wage in isolation, as long as that's been paid for 6 months.
Yes.
And they will exclude all of the business
retained
debt.
earning. Oh, exclude the business debt.
Yes,
okay.
exclude the business debt. So to do a full analysis, I mean, there's other lenders who will take the net profit and the wage and exclude the business debt. And take back a little bit of add backs like depreciation as well. So, but there's other banks who will do a full analysis and they'll look at the net profit, the wage, they'll factor in all of the company liabilities. And it just changes the picture so much between each lender on borrowing capacity.
There's all so these many
policy how you assess and the different. And I guess when you have that situation, it becomes way more complicated. So you need to get your accountant involved. You need to get usually brokers involved to basically advocate for the client, isn't it?
That's right. And quite often as well, in outside of the medico space as well, a lot of lenders will want to look at 2 years. So there are some lenders that will just look at 1 year in isolation. So there's only, a couple of lenders that will do that. But for the most part, most lenders want to see 2 years. And they might take the lower, they might average. Some of them might take, net profit. Some of them might take depreciation or a percentage of. They all look at it so differently. And I think since COVID has happened, all the lenders have looked for new ways to service self-employed people. And this is when they largely brought in all these directors' wage policies. So simple ways of assessing, quite complex company structures sometimes, or companies that have multiple shareholders. So you might only be a 33% shareholder of a company. So, what portion of net profit can you use? What portion of this can you use? So, those directors' wage policies are very, very useful where there are big complex, company structures in place and you just want to take, their incomes. But there's so many ways that you can assess self-employed and it really does vary. And we look at them all because, you might get a more favourable servicing position using one method over another. But for doctors in particular, as I said, most lenders will look at 2 years. But for doctors, they will more often than not just rely on the most recent year, or they'll rely on 1 year. Or they'll rely on interims, even if they're not lodged. So we're finding a lot now, a lot of people have their FY24 interims ready to go, but they haven't been officially lodged or prepared. There's many medico teams that will use that for the purposes of servicing.
Oh, yeah. Excellent. Yeah.
And the sole trader question. So I suppose when someone's a sole trader, there's no separate entity. And so if they take out a car loan there's no other real way to look at a sole trader. They sort of...
It's a bit easier in that way because you don't have the company entity, the retained earnings and all that sort of thing.
There's no sort of creative way to look at a sole trader. It is what it is. And we can't isolate business liabilities. Like it all sort of just comes into the one melting pot. So that's a bit of a difference. But in terms of the medical space, they will still look at a sole trader in a similar fashion to like what I mentioned with annualizing a BAS. So, but a sole trader might not always do BAS and they might not do interim financials and have draft profit and loss and things like that. So if you are a sole trader, I would think it's good to do that and have that software so that you can prove what you've done over the 12 months. But I think a lot of sole traders sort of start out and doing their own accounts and things like that. But your options would open up greatly to be utilising a bookkeeper or an accountant to make sure that there's documented evidence of what you're earning and what your expenses are. It just makes it much easier to get these policy exceptions through.
Yeah, absolutely. Because like some early career specialists, once they come out, they do a bit of in the public, a bit in private. And when they start out in the private, their private earning might not hit that threshold for quarterly BAS reporting. It might just be a yearly reporting initially, and then with that to build up. So that definitely can play a part. If you're a sole trader, it's easier because it seems to be assessed at the personal level, but for medicals and other professionals, they might assess it at just 1 or 2 passes and they would get across the line. Whereas if you're operating via a company, there's just a lot of different levers and structures you can play with. So now let's get to the next part. When we talk about income, there's also investment income. How do the banks view sort of investment income when they come to assessing your total income, I guess?
Yeah, well, I suppose for an investment property, they do look at the rental yield over, they'll ask for rental statements. So whether that's $500 a week or whatever that is, and then that will contribute to your overall serviceability position. They will also factor in the associated liability, and they'll also factor in any sort of costs that you incur during the year for that rental property. The banks have these calculators that we put everything into, and then they do in some circumstances factor in any sort of negative gearing and the effects that will also have on your serviceability. And some lenders are better than other lenders at doing this. But yeah, they just look at the rental income. I mean, short-term rental and Airbnb and that sort of thing is, probably another, it's probably another kettle of fish.
It's becoming more popular.
It's becoming more popular. Not all lenders accept it. But, generally in those circumstances, we will need to look at your tax return just to figure out exactly what you yielded over the last 12 months. It's not as black and white as just providing last month's rental statement and just going and earning $500 a week.
Yes. Yeah, because they're short term, right?
That's right.
Yeah.
That's right.
Yeah. Well, I mean, we're seeing that in, there are a couple of people that do get, say, holiday homes, and then they'll rent it out to Airbnb when most of the year, and sometimes they'll use it themselves. And so that one, I guess, like any other business, that should be sort of annualized. And if you want to include that income in your assessment.
Yeah, they need history for that type of income because it can fluctuate significantly. So it has been a bit of a grey policy area because they're quite it's only been quite recently that they've become quite popular. And yeah, I think it wasn't such a big thing a few years ago, but through COVID, everyone was trying to, buy investment properties and go local and buy holiday homes in Australia. So it is more common these days. But yes, we would typically need to get either 12-month statements or a tax return to back that income up. And this, because the income, they yield well, but the expenses are so high because they're managed and there's cleaners once a week, every changeover, and there's people that have to be employed to take the bins out and maintain the property. And, the customers have to still pay the electricity and the internet, and the expenses on them are actually quite high.
Yeah, they're substantial.
They are, yeah. So even though you might, it might come back on a statement as yielding $8,000 a month, you might, as the owner, might only see 2 or 3.
And I guess, when I look at that, say you have a property that's making a regularly rented out property that's, say, making $500 a week, and your expenses minus interest and everything comes up to, say, $400. The bank doesn't assess you at that $100. They apply different discounts and also different additional lending requirements on the interest you're paying on that.
That's right.
We've touched on that previously, but
yeah.
So in a situation where you might be cash flow positive, you could be assessed negatively for your investment properties.
Right. Usually,
because quite often they'll buffer the income that's coming in, and then they'll buffer the existing liability as well. So when you put that liability into the calculator,
expenses as well. So
they benchmark expenses.
Unless you declare more.
Yeah,
they'll benchmark a minimum.
Okay, so there's a minimum expense, and then there's a buffer on the interest you're paying.
Yeah,
and then there's a discount on your income.
That's right.
So everything is buffered. Yeah. So you're really assessed negatively, right?
Yeah. For that. Very rarely do we see a positively geared assessment on an investment property.
Yeah. And that obviously then comes to the issues as investor accumulates more and more investment properties, the amount of money they can borrow becomes less and less, even though they have become wealthier and wealthier.
That's right.
So, what are the ways to, and I know of ways, what are the ways to sort of overcome that?
Well, I suppose some of the ways is, if you know that your goal is to accumulate property over a long period of time, I think it's really important to engage a strategic accountant early on. They can help you structure for growth sustainably, because eventually at some point, once you keep purchasing properties, your personal capacity is going to cap out and you're not going to be able to purchase any more properties. So regardless of, your income's going to cap out at some point as well. So there are different ways that you can structure things so that you can grow your property portfolio sustainably. And some of those include purchasing within a trust structure or within what they call an SPV, which is a Special purpose vehicle.
Yeah.
And those properties would then be owned by those SPVs or those trusts. So what would happen then is, you would still be responsible for servicing those loans. But the idea is to put them in the trust or the SPV, and for them to be, hopefully positively geared. And the idea is that they will look after themselves within that trust. So the rent would pay off the interest and so on. And then for further assessments, the most important part is that we can then silo these purchases in these entities. And a lot of lenders with an accountant's letter or a declaration from the client will actually ignore that entire entity. So if we can just say that entity is operating profitably and looking after its own debts, the lender will actually ignore that for any future servicing. So that's siloed, it's positively geared, it's sitting in its own little pot over to the right there. And this is how people grow really, really big property portfolios, is through trust and SPV.
I think the key factor there is you need a big deposit for it to be neutral or positively geared, especially with the rates.
Time. Yeah.
That's right. That's right. With the rates doing what they're doing. Almost everyone at the moment entering into an investment purchase, unless you're putting in a significant 40-50% deposit, will be negatively geared by a particular amount. So that is a key factor. But obviously in this space where doctors have significant cash flow, in conjunction with the accountant's strategy, that is an option to grow.
Yeah, so it's really to know what you're going to be doing in the next 5, 10, 20 years.
Yes.
Because if you're looking in immediately, you want that negative gearing to offset your tax bill. But perhaps in the long term, that will severely limit on how much you can borrow.
Yeah, that's right.
It might be
a bit of a balancing act.
Yeah, it's a bit of a balancing act and knowing where you want to be in 20 years. So if you want to build up like a 10 property portfolio, you're never going to achieve that in your personal name.
Right. Yes. That's why it's so important to engage a good team quite early. Let them know your goals, because I think, quite often we see so many people that, have 3-4 properties, and by that stage they're capped out on their capacity. So it's really hard even to make another purchase within a trust.
Myself included.
So, sometimes
refinance, you really become handcuffed.
That's right. And I think sometimes you have to, if your goal is to continue purchasing properties, is to take a step back, to take a step forward. So whether that be transferring a property into a trust, but again, that's going to have some capital gains implications, or if it's selling a property, again, capital gains implications. So it frees up some of your capacity, some of your personal borrowing capacity. So by removing some of that debt from your personal name, it's enabling you to make another purchase that's siloed in one of these, trusts, for instance.
Yeah. So I think that whole siloing exercise is definitely something worthwhile exploring if one wants to build a large property portfolio. Yeah.
And there's also, I don't know if you want to go into it today or in another episode, but self-borrowing within super.
Oh yeah, that's a
whole nother topic. That's another way that in the current environment, when people have capped out on capacity, we're getting a lot more inquiries from people using their super to purchase properties. So it's just another aspect and strategy to continue to invest in property if you're in that sort of handcuffed position until the rates sort of start to come back.
And usually in self-managed super funds, they become positively geared quite quickly because the deposit is larger, and you can't negative gear within.
That's right, because they service them very differently within the super fund.
Yes.
So they're really only reliant on your super contributions and the rent to cover the loan. So it's a really different way of servicing the loan, because it doesn't take into consideration your personal income. It just looks at your super contributions and the rent. Yeah.
So I guess there's lots of different ways to sort of silo that and take that liability away from your individual name into a structure. But as long as that structure is positively geared and profitable, it's fine, isn't it?
That's right. I mean, it won't. Yeah, I mean, it won't work on the lender servicing calculators unless it is positively geared. So yeah, that's one of the main hurdles of getting in. Yeah, and quite often they're not. You know, people have huge amounts in their super funds, and they're like, "I want to buy this big property within the super fund," but I'm like, it actually doesn't come down to your normal servicing scenario or how much money you've got in the fund. It actually comes down to your contributions and the rental return.
Yeah. And I guess the way to, if you wanted to buffer that up, you have to put in a non-concessional contribution in there.
That's right.
Yeah, to buffer that enough to make it positive. Otherwise, they're not going to.
That's right. Yeah. Then that eats into your personal borrowing capacity. So we've got to be quite careful, because then if we're doing loans in your personal name down the line, we've got to factor in that additional contribution into your super, which will affect your borrowing capacity.
If it's an ongoing thing.
That's right. Yeah, if it's more than a once off.
Yeah. So, I mean, all of this gets complicated very quickly. And, there's a lot of nitty gritty detail on what one can do, and strategies to play. But it sounds like the take home message is, if you're not a vanilla employee and you've got complex needs, it's best to go with a broker.
Yeah, 100%.
Right. I think 3 out of 4 loans these days are written by a broker.
Yeah. So tell me, how does the engagement process with a broker go? I mean, it's for someone who's never used a broker before. How do they approach?
Yeah, so we are largely digital these days. And I think, traditionally, even just before COVID, not even that long ago, brokers used to do a lot of face-to-face meetings. But since COVID, all the banks and lenders have come a long way with their ID technology and just their technology in general. So our dealings are largely over the phone and via Zoom. So we would have an initial consult with you. You'd book a meeting. Ideally, it's great to have all your information up front so we can take a bit of a look and be able to steer the conversation when we see you, or at least have an idea of what you want to do, and if there's any sort of, because we can look at something quite quickly and go, that's going to work or that's not going to work. So then we can have a conversation with you about, what you want to do, what your goals are, how everything's structured currently, what you like, what you don't like. So we use it as a real fact-finding exercise to then go away and come up with a strategy for you.
It's a personalized strategy.
That's right. Yeah. So then we take away all your information along with the conversation that we've had, and then come up with a strategy and present it back to you. So more often than not, we'll send it through in an email, and then we like to have a phone call just to discuss everything, what you want to do in terms of next steps. And then if you decide to proceed, it'd then go into the application stages, and the team will help process that.
Yeah, and all of this is for the client, it's free of charge, right?
That's right. So, in most circumstances, we don't charge a fee. So if we know that a loan, because of the way that we're paid, so if we know that, the loan is going to be 100% offset, and we're not going to get paid, we might just charge a nominal fee up front just to cover some of our time.
Yes.
Or if it's a complex scenario like bridging, particularly if there's bridging with no residual debt, we will charge a fee for that. But, 99% of cases, probably we do not charge a fee. We get remunerated by the lender for bringing them business.
Yeah. And, it's you're paid by the lender, but then you're also servicing the individual.
That's right.
Yeah.
So, as a broker, part of our, commitment to you and our service agreement is that we will then look after your loan for the life of the loan.
Yeah.
And we have quite a stringent post-settlement process as well. So at the moment, we are repricing every single customer on our books every 6 months. So we are checking in with the lender, we are pricing them, we are making sure that you're on the most competitive rate. And then if you're not, we're looking at options to sort of, move you elsewhere, or having discussions around what you want to do and what your plans are for the future.
Yeah. And I think that continuous engagement process is when I heard that's what you guys do, and it's just like, oh, that's amazing, because
it's quite critical, because with the interest rate movements that we've seen in the last 2 years, the banks haven't always been forthcoming in passing on some of the savings, and also the savings and the
they might hike a bit more out of interest.
The base rate might jump up more for an interest only loan. And if we're not checking that, we're not advised. The customers often don't check their rates. So we have a team who are dedicated to basically making sure that every loan on our books is always where it should be. And if it's not where it should be, we fight for it to get to where it should be. And if it's still not where it should be and it's worth moving, we might have to move it. But a lot of people are in a position right now where they can't, they're locked in. So
because of the serviceability issues.
Yes. And unfortunately, the lenders know that.
Yes.
Because they've got all this data, they see your income coming in. They're like, we know that you can't move this loan.
Yeah.
So in that instance, one lender in particular, one of their strategies is, their retention, they don't have a retention team anymore, but their strategy is you can use our fixed rate then. If you want to stay with it, if you can't move, but your rate's on 6.2 or 6.5, but our fixed rate is 6.5 or what is it, 5.6 or whatever it is.
Yeah.
You can fix, which, locks them in with that lender for another year.
Yeah, it does get competitive with the lenders.
It does. Lots of different strategies at play, but I
think it's just important to just have your finger on the pulse there, because the rate you put them into does not always end up the same
it changes
market leading rate over time. So if you're not monitoring it, you should be. And we see this a lot. I had a client recently who came to me with about 10 different facilities, and they were all between 8 and 10% interest rates.
Oh, wow.
They hadn't reviewed their loans for like 20 years. And they've paid hundreds and hundreds of thousands of dollars more than what they should have been. And I have repriced those before I'm going to move them. But before I do anything, I approach the banks and reduce the rates straight away. And they could have done that 10 years ago and they didn't do it. So if there's a message in that, it is get your rate looked at by anyone. A broker can do that for you even if they didn't write the loan. We can approach the banks on behalf of anybody to reduce an interest rate if it's not competitive. So it's very important. Yeah,
that's very good. I might take you up on that.
Yeah, it's worth it. And it doesn't take long, and it could save you so much money.
And I think that's something we should probably get going within our group as well. And just a little plug for the Investing for Doctor group. What we realized when we started doing these home loan surveys, which is something we do once every 6 to 9 months, is that we get people to actually go and look at what rate they're paying, and then to submit those rates. And so we get a collective of that, and then we can say, hey, this is what your colleagues are paying. It's always a bit of a competitive streak to who can get the lowest rates. But it more serves as an exercise for people to remind people to actually look at their own rates, when you don't have brokers like yourself reminding them of that. And I think that's such a valuable thing that we're doing. And it actually saves people money.
I saw it collectively saved, $1 million?
Over that. The last time I calculated it, if everyone who submitted their rates were managed to negotiate their rates down to the median, we would have cumulatively saved about something like between 1.5 to 2 million
in interest.
That's amazing.
A year.
Wow.
A year.
And there's so much interest,
and that's the people who have submitted.
That's right.
That's right.
And particularly for doctors, like you guys do shift work, you're so busy. So quite often, more often than not, these loans are set and forget, and they're not top of mind, and they don't think to check them.
I've seen some crazy rates as well.
I know.
The 8% is insane, but I've seen some.
On $3 million they had in total. It was just.
Yeah, wow. Okay.
Yeah. So just be mindful and check the rate regularly.
So I guess to conclude is that it pays to actually review your rates every 6 months. Just take up your phone app, have a look at it, spend 5 minutes looking at it, and if you feel like you're paying more than you should be, then have a chat with the bank or have a chat with the broker or whoever got you the loan in the first place. Very simple thing to do, and can save you a lot of money in the long term. I think
it's especially important to do as these rates start coming down, because the banks more often than not might not pass on the full 25. If it drops by 25, a lot of them hold on to some margin, and you might not be told about that. So monitor it, because the variances between banks fluctuate a lot as the rates reduce. So it's just something to be extra mindful of as RBA starts to drop.
Yeah,
which hopefully will
brilliant
be soon.
Advice. Yeah. And so we've talked a lot today, and I think we've learned a lot as well. So thank you guys very much, and we'll love to have you again on the show.
Thank you.
Thank you. Thanks for having us.
All right. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.